Well, look, guys, the macro's breaking down and it doesn't look good. We expected this to happen. It's going to get worse. We're going to dig into that right now. If you're just interested in the charts, you can skip right to them. They're on the timestamps below, but I would encourage you to hang around and hear this because things are developing rather quickly. And as this starts to break down, things will cascade. We will get contagion and the macro will get even worse than it is right now. So without wasting any more time, let's hop right to it. All right, guys, we're going to start here with the U.S. national debt clock. As you can see, we're approaching $31 trillion. And this is the basis for all of the problems that we have. It's not just the United States. It's most Western nations. It's most of the world experiencing the same problem at the same time. This is the end of an era. This is the end of a paradigm of fiat currencies. Look, they're all collapsing, and we're going to get into that. But what you have to understand here is that the Fed is out of rope. And I'm telling you right now that they're going to pivot. But I think what most people get wrong, I think what most people don't really appreciate is that if and when the Fed does pivot, it's not going to be a good thing. It's a bad thing because it means one of two things, right? It means either something is broken and they have to stop, or they've reached their mathematical ceiling. And what do I mean by that? Well, you got to understand that for every 1% that they raised interest rates, I mean, look at the debt. That's $309 billion for every 1% raise in interest payments alone. Okay, interest payments alone. To put that into perspective for you, in 2021, the federal government took in something like $3.6 trillion in tax receipts. 3.6. In 2022, they're expected to get 4.2 trillion. Okay. So that's actually a gain of $600 billion. Well, all of those gains have been completely wiped out because they've already taken interest rates up to 3%. Okay, $300 billion per every 1%. They are now making less money than they were last year due to interest rates alone. This is not sustainable. The federal government cannot survive without either cutting spending on a massive, massive level or by borrowing more money to kick the can down the road, right? But here's the issue is that we've run into a energy crisis, okay? So the government can't grow their way out of it anymore with GDP, which, by the way, we've already had 2 consecutive quarters of negative GDP growth. And now we're about to have a third in all likelihood. This is not sustainable. Everything is falling apart. GDP is collapsing, okay, as debt goes up. All right, so we're not going to make it out of this thing. Just look at what's happening with the pound. So the pound is tanking, all right? And why is it tanking? Well, because they have an energy crisis, a sovereign debt crisis at the same time. And what is their response to it? Well, they're trying to cut taxes and print money to respond to this because they want to help people, right? They want to give stimulus to help the citizens make up for all these higher costs, but that doesn't help anything. This doesn't solve any problems. It just makes them worse. It just kicks the can a little bit further to delay the inevitable. Of course, the further you kick the can, the further you have to walk it all the way back to the beginning of the road, right? So this is bad. And as it should, the currency is collapsing as a response to this. It's losing all of its value. They have no energy. All they really have is a bunch of debt, and they're getting ready to take on even more with fewer tax receipts. It makes no sense, but this is what they're doing. And this is the basis for everything that I've been saying since I started this channel. This is what was going to happen. This was the obvious outcome to all of this. And we know it because all of this has happened in the past, right? And politicians always respond to these problems the same way. They always try to print their way out of it. They always try to kick the can down the road. And nobody wants to face the masses and the pitchforks during their time in power, right? They'd rather kick it along and either be dead and gone or out of power when everything finally collapses. I mean, you just have to appreciate that these politicians aren't going to willingly accept responsibility for this collapse. So they're going to try to do everything they can to get out of this. But everything that they do is just going to make the problems worse. And so as the Fed raises interest rates now, it doesn't really matter what they do anymore. The damage is already done. It's all baked in. This whole system's starting to crumble. Okay, and the pound is one of the first couple of victims. Look at the yen. Look at Japan. They're printing quadrillions of dollars to peg their bond market at negative interest rates. And they have to, because if they let that collapse, then they lose their entire pension system, their entire economy collapses, which is ironic because they're having to destroy their currency to do that. Do you understand? It doesn't matter anymore what happens. It's all on the way to falling over. Everything's teetering on this toothpick and it's getting ready to collapse, and you're starting to see the dominoes fall. So again, the Fed is going to pivot. I'm quite convinced of it. I think that this recent hike was the last one, certainly the last meaningful hike. They might raise again 25 or something for the sake of narrative alone, but that's all it is, right? That's all it is. Nothing they're doing is going to actually fix anything, right? They're actually bringing about the collapse, okay? And so what you have to appreciate is, just like what they're doing in Europe, we're going to do that here in America too. And, you know, Elizabeth Warren is pretty much telling you that she can't wait to do these things. She can't wait to spend money and bail people out of these situations. And look, it's not just that the currency collapse is taking place now. It's not that this is just starting to unfold. It's also escalating in terms of the war and in terms of energy. So the Nord Stream pipelines have now been sabotaged. All right, these things rest on the seabed. They're very deep, and they were made to withstand natural forces that might break it, obviously. Well, it's become quite clear that not just one, but both pipelines at the same time are experiencing massive leaks, okay? And this is a direct result of sabotage. In fact, you can read this Reuters article right here, and it tells you as much. So today we faced an act of sabotage. We don't know all the details of what happened, but clearly it's an act of sabotage. And why you know that is because, as I said, these things are on the seabed. The only way to get down there and damage these things is with some kind of a submarine or some kind of like a Navy SEAL special operation type deal. I mean, it's an advanced operation to damage these pipelines, and they were damaged. So now you have to ask the follow-up question in your mind, well, why? Why would anyone do that? Well, would Russia do that? Would Russia cut off its own leg? I mean, this is how Russia survives, is by exporting all of its resources. That's how they survive. That's what they're rich in. That's what they're wealthy in, is natural resources, oil and gas especially. And this is the pipeline in which they use to deliver their gas to Europe. Okay? And so why would Russia cut off its own leg? It doesn't even make sense. It doesn't pass the smell test. So you have to follow that up with who else might do it? Well, if you're the United States empire, right, and you have all of these vassal states that you're commanding to go along with your proxy war in Russia, okay, and you're telling them to eat the pain along with everybody else in unison while we fight this big bad bully, okay, eventually you get to the point where we are now, where some of these vassal states are starting to say, you know what, this is too much for us. We're not going to make it, right? Winter's going to be too hard. We don't have the energy. Like, we can't survive on core wood, chopping down trees to make it through the winter. Okay, we can't afford heat in our homes. We need Russia's resources. So we agree Putin's bad. We agree we don't like this guy. We don't like Russia, but we should at least be able to buy their energy for now. And as the empire starts hearing their vassal states deflect in this way when they're ordered not to, you might suspect sabotage. Now, who might do that?
Let me answer the first question first. If Russia invades, that means tanks or troops crossing the border of Ukraine again. Then there will be no longer a Nord Stream 2. We will bring an end to it.
How will you do that exactly? Since the project and control of the project is within Germany's control.
We will, I promise you, we'll be able to do it.
You see, guys, all the answers are right in front of you. So as the sovereign debt crisis plays out, as the dominoes begin to fall, as these fiat currencies start to go up in flames and the end game begins to play out, the war itself for energy and resources against Russia is being escalated. Do you understand that there's really nothing positive that's going to come out in the near term? Nothing, right? And I'm telling you that not to be afraid. I'm telling you that to appreciate the situation for what it is, so you can prepare in any way that makes sense for you. But by all means, at least understand it intellectually, right? So you're not shocked by the waves that come, right, from all of this. Because believe me, waves are coming. And now the damage to these pipelines is likely not going to be repaired by winter. And so it stands to reason that Europe will have a major issue this winter. It's going to be bad, okay? And that's not good for anyone, especially Europeans, okay? So these things are unfolding. And again, this is why I say the Fed is going to be forced to pivot. They have to pivot, but that's not a good thing. All right. It's not a good thing if they keep raising. It's not a good thing if they pivot. No matter what the Fed does now, it's all bad. All right. And once you figure that out, it helps you to navigate these markets and position yourself for what's next. And that's my point, is to be ready, be prepared, and understand the situation intellectually for what it is and what's to come. Okay. And look, this is not one pipeline. This is 2 pipelines. All right. It's a clear act of sabotage. But even despite 1 or 2 pipelines, are still doing better than all these food processing plants. So as we go through this drought, this culmination of the drought and floods around the world that's destroying crops or preventing crops, as we lack Russia's natural gas and fertilizer to aid these crops, right, to help them grow. We don't have that either. So we don't have rain and we don't have fertilizer. Our crops are already coming down. We're not going to have them in the abundance that we have in the past, nor the byproducts that come from them either. And at the same time, this is all happening, right? Now our food processing plants are all suddenly going up in flames. And just how bad is it? Let's take a look. Van Drunen site is a total loss after the fire. Explosion and fire reported at Cargill Nutrien feed mill. Explosion causes fire at northeastern Oregon potato chip plant. Fire at Winston Weaver Company forces thousands to evacuate. Portion of Wisconsin River Meats plant, a total loss after overnight blaze. Louis Dreyfus reports fire at largest U.S. soy processing plant. By the way, when you read a lot of these, it is either a total loss or damage devastating enough, it'll take a year or 2 to come back online. Farmers helping farmers following St. Albans fire. Again, this is related to cattle. Investigators seek reasons for shearers' food explosion and fire. Fire at Nutrien Ag Solutions in Sunnyside. Fire shutters Arkansas Nestle frozen foods plant. Farmers in northeastern Berks come to aid a fellow dairyman in rescue of cows burning from barn. Fire at Belfast potato facility ruled accidental. 50,000 pounds of food destroyed after fire ripped through Maricopa County food pantry. Fire damages Rio Fresh Onion warehouse facility. Cattle, again, rescued after fire destroys meat market. A plane crashes into Idaho potato and food processing plant, killing the pilot. See, guys, look, this is unprecedented. Right? Never before has fire been enough. Now they got to take planes and smack them right into the side of the building. Right? You got to keep an eye on that. It's never happened before. Taylor Farms regroups after fire raises facility. Fire destroys Azure Standard headquarter facility. Fertilizer plant forces evacuations in Kansas town. I mean, during a drought in which we have reduced resources anyway, during a war with Russia, which we have reduced fertilizer anyway, not only do we have a food crisis, but incidentally, all of our food plants and fertilizer plants are all catching on fire. What a coincidence. Investigators comb through plane crash wreckage at General Mills plant in Covington. Because see, guys, you know what? Sometimes one plane's not enough. Sometimes you got to take a second plane in there to get the job done. Chesapeake Fire responds to industrial fire at Purdue Farms facility. Canadian Pacific freight train carrying potash derails in Alberta. Now the trains are crashing and they happen to be carrying one of the major ingredients that we need for fertilizer during a major food and fertilizer crisis. Tens of thousands of chickens killed in Wright County egg farm fire. Fire damages JDBS foods plant in Green Bay. 70 firefighters, 70 battle blaze at Festive Foods frozen pizza plant in Portage County. And this one's brand new. 2 days ago, the largest wholesale fresh produce market in the world is on fire in Paris, and the damage is going to be catastrophic. You can call this stuff a coincidence if you want to, right? You can call Nord Stream 1 and Nord Stream 2 both going offline incidentally at the same time in what is all but likely to be sabotage, as we have a proxy war with Russia, and the primary fight, the primary battle right now is over energy. And you can say that as we go through this food crisis, in part to drought, in part to the war, in part to the lack of fertilizer, in part to all of these things catching on fire incidentally at the same time all across the world. You can call that all a coincidence if you want, but I would encourage you to pay attention. And that's not even addressing housing. Housing is about to roll over like a dog, because you got to understand something, guys. This is not 2008, and this is what frustrates me when I try to talk to people about the housing market right now. They say, oh, it's not 2008. This is different. That was different back then. Yeah, you're right. It's not 2008. It's 2022. Okay, and it is different because the situation is entirely different. That doesn't mean that we don't have a housing crisis on the way. And trust me, we do. just take, for example, anecdotally, some of the states that were more or less insulated from 2008, like my home state of Texas. Okay, so 2008, Texas didn't feel the pain of '08 like states like California did. All right, it was substantially different. I mean, Texas more or less kind of went on about its business during that time frame. But this time, you have to understand things are different. So consider this. Texas doesn't have a state income tax. We have property taxes, okay? And these property taxes get reassessed every single year. Well, if you bought a home in the last 2 years in Texas, for example, then the odds are very high that your mortgage payment every single month is guaranteed to go up year over year. And the reason is because when you bought that house, the likelihood that it had appreciated in value by at least 50%, possibly more over that time frame is very high, which means that when you bought that monthly mortgage payment, and this, remember, this is something too. When people go and buy mortgages, they don't buy the house that they can afford. They buy the one that they can get the loan for, right? They don't buy the home, they buy the monthly note, all right? And especially if you're having to outbid people in a tight market, then you really had no choice but to get the most you could afford, because you wouldn't have got a house, right? And so people are buying these monthly mortgage payments. Let's say it was $1,000 a month, okay? I can afford $1,000 a month, and that's what my mortgage is. Well, especially people who lived in all these other states moving to Texas who really weren't familiar with the property tax system, I guarantee you they did not account for the inevitability of these higher mortgage payments, because the state of Texas can only come after 10% of that appreciation in value year over year, which means in all likelihood, when they bought this home, that current year's appreciation wasn't factored into the mortgage, right? Or in the escrow. So there is a very high probability that the following year they bought that home, not only will they have to pay that appreciation in the tax assessment, okay, but they'll might have to pay back taxes on their escrow, which did not account for the appreciation of that year. All right. And so it will take years and years and years for the state of Texas to catch up to all of this massive appreciation in these home values, meaning it is all but guaranteed that year over year over year, the mortgage payment that these people signed up for $1,000 isn't going to be close to $1,000 in a few years, right? You're talking, it'll go to $1,200, $1,300, $1,400, $1,500 just on the tax assessment appreciation alone. And so these people thought they bought a home that they could afford. Suddenly they're going to get priced out of it when the tax man comes to get the appreciation on a home that they didn't anticipate or understand. I guarantee you that's going to happen. And so even states like Texas that might have otherwise survived, you're going to have a lot of ignorant newcomers to the state and the system who did not appreciate these variables, who are going to get smoked. And it's not only that, it's the property, it's your insurance on your home too is going to go up, because as these home values continue to go up, the cost to replace the home goes up. So if your home catches on fire, it has to be rebuilt. What's the price of a new home? Well, all-time high, right? And so the insurance cost on your mortgage has to keep going up to keep up with that too. Okay, so your monthly payments just keep going up and up and up, right? And so look, and you got to consider too, electric rates are going up. You have all the inflation that you already have, right? Whether it's the food, whether it's the gasoline, whatever, we all understand it. It's massive inflations out there. And now your mortgage is going up. You bought a $1,000 mortgage thinking it was $1,000. And after a year or two, now it's $1,200, $1,300, $1,400, right? And you didn't account for that on top of all the other inflation, on top of your electric rate doubling, right? Maybe tripling, right? I mean, these kinds of costs are just building up on people, and they're going to get priced out of their own homes, the homes that they're already in. It's very possible these people get cut out, right? And so, look, this situation is worse than people think. I think it's worse than people appreciate. And some of the more insulated markets in the past, like Texas, I think are going to catch a lot of people off guard. And so this has a long way to fall too. And right, what's the government's response going to be to this? Are they going to do COVID all over again and let people stay in their homes and not have to pay their mortgages? Or are they going to mail checks for their mortgages? Well, that's not going to solve anything either, right? Because you're just making the problem worse. If people aren't productive and they can't pay their debts, but you're sending them money in the mail when you already have a sovereign debt crisis and inflation, you're just making it worse. Okay, so look, this is getting ready to roll too, right? And this is why I sold my home in anticipation of this, right? And so I'm out of the market, right? I'm completely out. My landlord's a sucker because he let me sign a 3-year lease, right? I don't care what happens to the home values. I don't care how much his appreciation goes up. I don't care how much he loses, you know, because I'm locked into a rate, right? I am locked in, so I'm insulated from all this stuff. And, you know, I think you really have to take the time to consider what's happening here and just know that all this stuff is going to roll over, right? And, you know, you had people who were close to paying off their mortgages and they refinanced and took all this debt back over again. That was a large part of inflation too, because you had all this cheap money that went out to regular everyday people through their mortgages, right? And they went out and spent all this money, and now they're starting all the way back over at these record high prices on mortgages, and they're just set to roll over. Look, this is going to hurt. This is going to hurt a lot of people. So this is just one more element in a big old pot of stew that's souring really fast. Okay, so let's get into the markets. I can tell you they look bad, and they're probably going to get worse. I see no real reason for them to rally. Again, even when the Fed pivots, it's not going to be for a good reason. It's going to mean bad things. So I think the broad markets have nothing but downside left. Just to reiterate, in case you're new, my next target would be 3,400 on the S&P. You know, that's always been the base case for the full-on sell-off. And you'll have to see how it reacts there. But should it ever manage to lose 3,400, I'd be looking at about 3,000 from there, okay? But I also don't necessarily know that it goes lower than that because if they let this thing break too much, there's too much contagion. There's too much leverage. And if you let too many things break, then it's hard to put Humpty Dumpty back together again, right? I mean, you really lose control. I mean, you have $9 trillion in liabilities on pensions. Right, you let pensions roll over. How are you going to fix that? You're going to print $9 trillion and just make it all clean, right? It just doesn't make sense. So either they let this thing full on break, or they stop it, you know, 3,000-ish, something like that, I think. But we'll obviously see. But for now, the big picture view is lower. When we look at the yields on the bond market, I mean, they're just totally collapsing, right? You know, the 10 years at 4%. I honestly did not think it would get this high, so you know, pat on the back to Jerome Powell for making a fool out of me. He really won this game in narrative. But again, that's all it is, guys. That's all it is. And all of this damage that he has now baked into the cake is on its way. But you guys got to appreciate that as these currencies everywhere collapse to all-time lows. I mean, this is all very bad for everyone, despite the strength in the dollar and the DXY, which again is taking a straight elevator ride up. I mean, that's bad for everybody too, okay? And so I do think these things are getting overextended. I think that we're kind of due for a sell-off. Now, just because it's going parabolic doesn't mean it can't keep going parabolic, but I would expect it to roll over and come back to, you know, 103, something like that. But again, we'll just have to keep an eye on it. It's doing its thing. It's gaining strength, and the stronger it gets, you know, the bigger it gets, and the bigger they are, the harder they fall. So, you know, Brent Johnson has been quite prescient in his call about the milkshake theory. It's obviously playing out, but so are the ramifications of it too, okay? So this is not sustainable. The strong dollar is not sustainable for anyone, including us in America. So my take on this is that we could continue to see it to rise, but I expect it to at least take a break sometime. The relevance of that is really, I think that it might be the catalyst because we might have a confluence. So whatever comes that makes yields kind of slow down or turn around, whatever catalyst makes the dollar turn around, even if briefly, will likely correlate, I think, to the Fed, whether it's a speech they make or the pivot itself. And why I think this is important is not for the broad markets too much. It's really about gold and silver because I still think gold and silver are the best plays. I think you're in an excellent position to accumulate here. And once we get those things, especially the secular bear in the broad market, which is only a few points away, it actually managed to break. I just saw that. It actually managed to set a new low, though it hasn't quite closed at a new low yet. It's got 2 hours to go. Once you do that, guys, the secular bear market's on the way, and it's nothing but downside here. And this is bullish for gold and silver, okay? So that's why I think all of that's important. But outside of that, it's pretty much bad for everything else. I really only see gold and silver standing to benefit here in the short to near term. Again, when you look at something like oil, I actually think oil is getting kind of close to a bottom here. You know, you have a strong support there at 70. Absolute low has to be 60. I would have to imagine from there, I would expect a massive rebound. You can just imagine in your mind the kind of catalyst that might bring that on. And it's everything that we talked about in the beginning of this video. I mean, the energy crisis is going to get worse, and the demand for energy is going to go up, especially as they print money to pay for it. And so all of that seems very good to me. Now, if we go to the gold and silver, I will switch to the weekly chart. You know, I still see a little bit of downside here, and I think that's okay because it gives you an opportunity to accumulate, especially if you're new. If you're just now thinking about this, this is great for you, right? You get kind of a sweet opportunity here to maybe buy a little bit cheaper. I think that's a really good thing. If you have no exposure, you're crazy. You need to get started. Again, I will stick to my call here on the gold price. We have broken down below this line. I ultimately think it results in a peekaboo, right? So we kind of tease that we're breaking and falling down, and then we're going to V-bottom and shoot right back into trend. That's my expectation. Even on the monthly chart here, you know, I think where it's about 1550 is probably the low. That's a knife I'm willing to catch. If we get there, I'll start buying pretty heavily there. But I've been buying gold and silver for the last several days. I bought gold and silver stocks on Friday, and I bought them yesterday too. And so I feel very confident about gold and silver going forward. I think everything looks pretty good on all time frames. Again, fundamentally, we're coming to the point where the narrative can only do so much. I think in terms of time, we're here. I think we're effectively here, and that whatever is about to break is in the process of snapping right now, right? I can hear the cracks in the bones. And so, you know, I'm accumulating, and I'm doing it in confidence, and I'm willing to go on record and say so at these prices. And, you know, with the expectation that we might get somewhat of a downside event, all right? We might get a liquidity sell-off and get one more flush. Outside of that flush, I think we're at the bottom, okay? I want to make that clear. Unless we get that kind of a flush, I think we're at the bottom. So that's part of why I'm doing it with the strategy that I am, saving with the possibility of a flush down. Just to come over to the ETFs real quick, SIL, again, you know, it's sitting at some pretty key levels here. We knew we might get down to 1882. SILJ, again, is kind of the same story. We thought we might get down about right here or so, right? So we're effectively there. Since my last video, I told you we had, you know, 10 to 20%. It's really dependent on how the sell-off occurred. And that's really what we're getting. GDX is a pretty good example of that. I gave you these golden zone to buy between, say, 26 and 21, 20. And we're coming down to test that. I think that's an extraordinarily strong level. I'm not sure that you go much lower than that, all right? I'm going to be a pretty hard buyer on that one. So you can kind of use that. Since I'm not going to go down every single equity and give you prices to buy on everything, you can use the power of confluence to do that for you. So if you see GDX at about 20, 21 bucks, right? You see something like AG kind of down here, 630, something like that. Maybe a 550 at the worst. You see these things happening at the same time. I think you have to jump in. That's what I'm going to do. Pause, for example, there would be good confluence there if you could come down and hit 14 bucks. All right. That's a pretty strong historical level. It tends to perform very well there. I like it. We talked about SILV in particular last time. I told you about the three levels that I'd be looking at. We had 507, 450, and 4. Well, we're effectively at 450 now. I think that this is an excellent buy zone. And you can see that it's kind of resting right here at what was kind of a choppy prior support. And remember, like I told you last time, the problem with this chart is that it didn't have a lot of history, right? And so I kind of had to feel that out. And that was kind of the area I was looking at right there, is that kind of bottom area in that chop. And it's getting a little bit of a bounce there. I will tell you that the technicals and all of the gold and silver equities are showing bullish reversals, okay, even on the gold price itself. This is a weekly time frame, so that's good. But you can see as the price sets new lows on the price itself, we have a divergence in the RSI. It's a medium strength, but because you see it everywhere in confluence, that's good. Here's one that's a bit stronger. And so you set a new low in Agnico Eagle. You've broken that trend. You're trying to put it in a wick, but you have a divergence in RSI. Again, just to remind you in case you're new, or to stamp it into your brain if you're returning, the confluence that we have here on this weekly chart from where we are today and all the similarities in the past from March 2020 sell-off, right? You have the same RSI, the same breadth. 2018, same place, same place, same place. And again, in 2015, they all add up, do the same thing, putting in the same patterns that we're putting in right now. I expect this to be the bottom. I really do. The charts are really singing the song. They're telling you that they want you to buy. And so that's what I'm doing. I'm doing it with confidence, not just because of the charts itself, but because of the macro that we've talked about. This is a culmination of data, all right? And we're taking all of this data into one thing, all right? We're not just reading a chart like one chart. I'm just reading Agnico Eagle because that's what I want to buy. No, we're looking at the entire sector in a culmination and confluence together with the macro, with the broad market, with the Fed, with Russia. We're looking at all these things together, and we're listening to the story that's being told, right? And everything is lining up for a major move in the metals. And so I think everything looks quite good. Again, I am accumulating here, and I will continue to do so. But, you know, if we get a sell-off, I'll be looking for the gold price of $15.50. I'll be looking at the GDX somewhere around $20. And if we can get a confluence of those levels, then I'll try to make my first, sharp sell-off buy. I'll try to catch the knife right there, if that makes sense. But everything looks good to me. I think this is a premium opportunity to continue to buy. Hecla, Endeavor, everything looks good. You know, Hecla just won't give up this support, at least not yet. But, you know, it's still putting in these bullish divergences too. This is, again, on the weekly chart. I think people are getting this wrong. I think that they're buying all this narrative that gold is boring. It's not doing its job. It's supposed to be this inflation hedge. Why is it selling off? And they're getting duped out of the opportunity to buy when this is exactly the kind of time you want to buy, because this is exactly the kind of macro environment you want to buy. This is the kind of oversold valuation levels where you want to buy. This is simply where you want to buy. And so don't overthink it. Just accumulate. And you don't have to go, blow your load all in one shot, just accumulate, okay? Because again, there's no way to truly predict what the price does next. But if you accumulate and buy in tranches and, kind of spread yourself out and take new positions in some great companies, if you haven't listened yet, go listen to the interview from the Gold and Silver Spaces with Don Durrett. The guy lays out all the companies. We probably talked about 24, 25 gold and silver stocks in that interview. I mean, we have some of the best of the best. So if you're looking at, looking for names beyond the names like AG or PAS or anything like that, there's a lot more in there, and they're all covered with the due diligence of why that they're good picks. So, if you're looking for stock picks, I already got that for you too on the last video, so go check it out. But gold and silver look great to me. I'm going to continue to accumulate. I see no problems here. In fact, I see this as an opportunity. I'm very confident in it. Everything looks good to me. The charts are putting in divergences. It's just simply oversold, but it's not oversold in a bad way, where you can see that it's going to continue to sell off like the broad markets, like the S&P. Yeah, that thing's oversold too, but it's going to get oversold a lot more, right? I don't see the same kind of patterns there in gold and silver. It looks really good. Okay, we'll take a shot at uranium here. It's getting some nice rallies today. So what does it mean? Is it a turning point? Well, I don't think so. At least not yet. You'll see that a lot of the rebounds are getting stuck at resistance again. So not a big deal. This is a short-term time frame. This is, it could still play out. But until it starts breaking these key levels, you really can't get too excited. You're going to have a double confluence of resistance here, again, at this neckline on this inverse head and shoulders in the case of URNM, in addition to getting back over the 50 again. If you can do that, that'd be a good sign. But until you do, call it $69. This is probably just a dead cat bounce. After you have failed this pattern and had such a hard time breaking through it in the first place, the idea that it's going to turn around and rip up, I think, is unlikely, especially with the macro situation breaking down like it is, with the broad market set to sell off, with uranium's tendency to trade with the broad markets. I do not see this as an opportunistic time in uranium yet. Again, Cameco struggling with this prior key resistance. It got there, but it didn't break. Let's look at the daily zoom in on volume. I mean, nothing impressive about volume. Call it a little bit average, I guess. And again, you have a double confluence of resistance there. There's some insights for you. UEC was threatening to break this trend line, this long-term trend line, and it managed to get a bounce on it, so that's good. We'll zoom out on the weekly. All right, and No buy signals. I'll tell you that much. There are no buy signals yet. Again, another double confluence of resistance just above where it is. I would just hang tight. Again, to reiterate, especially if you're new, you should have taken the opportunity to sell these high levels because the charts were telling you, they were screaming that it was going to sell off. If you miss that opportunity to sell, really nothing in uranium has changed. You're still holding, especially if you're long-term. That's okay to hold, but you're still not buying yet. All right, there are no buy signals yet. Nothing about the charts have really changed. I mean, you've come down to critical levels and you're getting a bounce on them. So that is good, but you really have to see if it can follow through. I mean, you could very easily come up to these resistances that are just overhead and come back down, and then we'll see if the technicals are putting in a buy signal or anything like that. But right now, it's just getting an oversold bounce, I think. I don't think there's anything to get excited about or sad about. It's just trading, okay? It's just, it was oversold for a bit, and it's kind of getting a rally. Global Atomic continues to play very good technicals. It's a very easy read. It bounces on everything very beautifully. It's just straight shot, ding, 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 hits them all real perfect. I love that about this. Let's go to the weekly. And, the RSI has never been a problem for this equity. It's never had negative divergence or anything. It's just trading within its ranges. But as confluence has throughout the sector, you do have some immediate overhead resistance, 2 of them. And so it's simply not a good time to buy uranium. I think if you were tempted to buy uranium today, you really need to settle your nerves, dude, because on just a single day of action like this, you're going to go FOMO. It doesn't make any sense, okay? You need to hang tight, be patient, be cool, calm, collected like a cucumber. And look, Centrus Energy, since we were up here, what did I tell you we were coming? Exactly this level. And where did it come? Exactly this level. That was an easy call too. So that incidentally would have been a good time to buy, at least for a swing trade. It had a nice support there, but you still can't chase it now. Even if you did take that trade, like we talked about, then you might already consider taking profits. I mean, you really need to appreciate where you are, where your portfolio is in these markets right now as the macro starts to break down. So, long-term LEU might be a nice thing to own, but as is in confluence with the rest of the sector, it's not a buy opportunity yet, though that would have been if you just absolutely had to be in. The same thing is true with SMR, right? So when we were up here, we told you to sell. Okay, we talked about the potential targets of this trend line and this trend line. It managed to come all the way down to this trend line and touch it on the tick. All right, so there's your astrology for men playing out for you in real time. Look at that perfect bounce on that lower bound. Of course, the problem with that is that it's now retraced into this channel. Okay, so now it has a double confluence of resistance to get back out. I'm just not too confident that uranium is going to perform well enough to do that. It will be nice to see, I think, if you're looking for a buy opportunity, to see Cameco come down, $23, $24. That'd be nice. That'd be nice. And by then, it might be a bit more oversold with better technicals and more room to run. You might have enough opportunity to get the energy to get back up. But until that happens, you just got to be patient. Silex. Once again, since up here, I have been telling you what was going to happen on Silex. I told you it was going to break. All the technicals were there. The bad patterns. You had the bad RSI, especially on the weekly. Remember, when we were going through this chop, I said, look, on the daily time frame, in the short term, Silex had strength to do crazy moves. I told you that. And it could run up and do something crazy. It got up as high as 414. And I encourage you to take profits if you hadn't already. And on the weekly time frame, I told you, but it's going to come down. And it will kiss this trend line right here. This moving average, this 50. That's still a mile away at 213. As of today, getting close to the close here, you're still 30% away. Okay, so you can't even think about buying Silex until you touch this trend line. I don't care. I don't care. It's going to touch it. And, if you buy it before that, that's on you. But just know that that's coming. And when you get this overextended like this, I mean, that was the most clear sell signal ever. And it struggled with this too, right? Just like the rest of the sector did. This was a breakout zone for it. But it had already used so much energy getting there that the people buying up here were just FOMO chasers. This was, these are bag holders now, okay? And, you know, that's why it's so important to look at these charts. You have to get in on stuff early. You can't go buy stuff when it starts taking off. You have to understand ahead of time why you're buying it, right? You have to buy things when they're cheap. This was not cheap, okay? And but it's about to get a lot cheaper. So if you're interested in it, again, just like the rest of the sector, I would slow down and wait. Everything's fine. Just to remind you all, the big picture, this is the zoomed out view of Cameco, which is in a clear uptrend. This is a bull channel. It's an uptrend over a long span of time. Until that trend is lost, it is the trend. The trend is up and the trend is your friend. And this is a perfectly parallel channel here. I see people charting this all kinds of crazy funky ways, and they're all, that's not right. This is the only way to chart it correctly. This is a perfect parallel channel. So these are your touches, okay? So you come down to $24, $23, you can start looking at it again. You did get a break. I pointed this out in the past too, that you had this hidden bullish divergence, okay? So on the bottom of your RSI over time, all right, starting from the kind of the beginning of this run, you were setting higher lows, right? But you were setting lower lows on the RSI. This is a hidden bullish divergence. And what this is telling you is that the trend is likely to be maintained, all right? And as we talked about, this is a bullish trend, okay? So this was telling you every time you got down to these levels down here with the RSI doing what it was doing, those were buy signals, heavy. That's part of what gave us so much confidence to buy here and all through here, right? Because we knew that these were buying opportunities in a bull market. Well, incidentally, this is potentially breaking now, okay? This might be over with. We have to see. The best thing that could happen would be for Cameco to come back and touch this trend line again and then see if the RSI can't break lower. That would be good, all right? That would be good. Well, at least it would have been. I think it's kind of breaking. So this whole hidden bullish divergence might be over now. And that's the tricky thing about RSI is seeing and identifying where it breaks and changes, because it doesn't last forever. It changes. It might be changing now. And that might be another bad sign too. We'll have to watch and see. But it's one more element of confluence that I'm seeing that it's best to wait. Does that make sense? Just wait. Just see what it does. Long-term bullish, short-term, you can't buy. You get another rip like this on today, you might even want to think about selling if you didn't last time, okay? Because I don't see a whole lot of strength to follow through here, but we'll keep an eye on it. Okay, so as we go through the agriculture section, we're going to include John Deere and Grainger. These are major bellwethers. Again, if you didn't see the prior video, I mean, these are 40, 50-year bull channels, all right, which are extraordinary, extraordinary. And I kind of use them as an example of why you should not be buying agriculture stocks right now because of all the negative signals that they were putting in. And now you can see we've come down and rested on the top of this channel. I think it's very likely that it breaks. You know, 277 is an easy first target on the weekly. That's 16% from here. Again, if you come out to the monthly, it's 274. So there you go. That would be a strong buy even for a swing trade. All right, it makes sense that you'd get a nice bounce there. But beyond that, if you lose it, you know, you're coming back 173. So, you know, that's kind of a long way away. And to break out above this channel like this and fall back in, if it does, you have to really expect that it is going to fall, okay? And then again, to reiterate, with the broad markets rolling over, with the macro looking like total crap right now, it wouldn't surprise me at all to see something like that. The same is true with Grainger, all right? We knew we had clear sell signals coming in here. You can see the divergence on the RSI on the monthly. All right, this baby wants to roll over, all right? And so we are now down already 16%. That was an easy call. It was up here. So, you know, again, you have a, wow. So just the fall on the weekly is another 18%. That's in confluence with John Deere. So you can't be in these equities right now. You kind of got to stay out of them and give it a chance to shake out. This is a really tall, small, tight channel with a breaking macro. I would expect it to fall out, but we'll have to watch and see. But again, we're using this to give us a bigger picture on other names like Nutrien, okay? And Nutrien was kind of telling us the same thing. You know, you lost this trend, you struggled, you got back above it and immediately broke down. Of course, as you would expect, you played with the 50. And, you know, I don't see a whole lot of strength here. Again, you're coming down maybe 64 at the bare minimum. All right, that's 24%. If you can come down to this trend line, that'd be probably an excellent buy at about 60 bucks. I'd be looking at that pretty hard. And again, we saw kind of this ugly head and shoulders pattern on Intrepid Potash. And, you know, it looks like it wants to break here too. If it does, you could expect no less than about $28. So be patient in agriculture. You know, we've had a lot of success trading agriculture on this channel, but right now, you have to just hold. You have to hold and wait, not make any moves, and just see what it does. It looks net bearish to the downside. Corteva was another we had looked at, all right, and we called the roll off up here, all right, and here it goes down. You know, I would expect it. Let's look at the monthly. Not enough history to have 50 on the monthly. Maybe 2 weeks. Okay, so there you go. There's a confluence right there. That's pretty good support at 50 bucks. All right, you're at 57. All right, so we at least wait that far. I had told you guys, oh yeah, let's look at Oxy and get into oil. I actually think that this is turning into a buy because you have this ascending price pattern right here, and then you have this descending on RSI. So what this is telling you is it's just like uranium. You have that same hidden divergence in the RSI. So I actually think that oil is getting ready in the next few weeks, maybe, if not sooner, to turn around. I think Oxy's turning into a buy. If you have no exposure to oil and you're thinking about it, then I think that the price resting on this trend line is an excellent candidate for a small entry to get your feet wet. Because if you were to fall, you have a little bit of downside, but the chart's telling you that it's stronger than it looks, okay? Let's come back to the weekly time frame. It's telling you the same thing. It would be nice if it could do this a little bit longer. You could build up a little bit more energy. So maybe it kind of does something like that. But this is a good spot to consider Oxy. I think that the signals look pretty good. So, you know, vital metals, I had told you, you know, if we drop down, I'd try to catch it. We haven't fallen to the target yet. You know, this is not something you need to catch right now. It probably will fall a good bit more, but I think in the long term, it's something to watch. And so I will continue to do so. But everything, I would say, is going the way that we had expected it. I don't see any surprises. You know, the ratios are still playing out. Look, you're starting to kind of round up in the GDX XLE ratio. I think that's a big sign, guys. I think that's a big sign. GDX to XLK. All right. Still showing that it wants to turn around too. GDX to copper, same story. It's still all historically oversold. The GDX is oversold to every other, you know, energy ETF, copper ETF, tech ETF, you know, even the DXY. I mean, look at it hanging down here. These are the kinds of things that typically rebound quite strong. Again, it's just more confluence that everything is in the cards here for gold and silver to make a massive run. I'm extremely stoked about it. I'm very, I have a lot of anticipation of what's to come. Unfortunately, this is going to mean problems in the real world, but that's what gold and silver are. They're insurance, and you want insurance when you know, when your house catches on fire. So when you see the forest fire coming, go ahead and buy your insurance before your house catches on fire. Otherwise, it'll be too late to buy it. And that's kind of how I look at it. So despite how bad things may get, you could stand to make a lot of money out of this entire crisis. And again, one more, GDX to the S&P, showing this divergence that it wants to turn around. I think that that's coming soon. I think everything is in the cards for this to all play out. I think we'll be vindicated once again on the calls. And, you know, just be patient. Don't FOMO anything. Stick to the strategy. Everything will work out great, I can assure you.